Hello, how are you? Welcome back to yet another video as today I'm going to take you through a comprehensive guide to investing in stocks. You can start investing in stocks through a brokerage account like eToro or Robo-Advisor. But you should establish goals, review your financial situation, and determine your risk tolerance first. Rebalancing your portfolio periodically will help you keep your investments in good shape. Looking to maximize your money and beat the cost of inflation? You want to invest in the stock market to get higher returns than your average savings account. But learning how to invest in stocks can be daunting for someone just getting started. When you invest in stocks, you're purchasing a share of a company. They're basically a slice of ownership in a company that can yield returns if it's successful. There are various ways to invest and leverage your money. But there's a lot to know before you get started investing in stocks. Step 1. Figure out your goals. It's important to know what your fundamental goals are and why you want to start investing in the first place. Knowing this will help you to set clear goals to work toward. This is a crucial first step to take when you're looking to create an investing strategy later on. If you're unsure of your goals, first review your financial situation, such as how much debt you have, your after-tax income, and your expected retirement goal date. Knowing when you plan to retire can let you know your overall time horizon or how much time you plan to hold onto your investments to reach your financial goal. Step 2. Determine your budget. Once you've got some solid goals set, it's time to review your budget. Here are some things to consider. Your current after-tax income. Many people look at their pre-tax income, but you want to know how much money you're working with after taxes, which can help you create a realistic budget. Your expenses. How much are your monthly expenses? How much do you have left over each month? Is it possible to reduce or cut some expenses? Overall debt. How much debt do you currently have? List out your monthly payments and compare that against what you're making. Net worth. Your net worth is your total assets minus your liabilities. This number can give you an idea of where you're at financially and will allow you to get a big picture snapshot of your financial health. Financial goals. As we mentioned before, knowing your goals is important as it gives your money a purpose. Risk tolerance. How much risk do you feel comfortable taking on? Calculating this will give you a clearer idea of what you can afford to lose. Step 3. Get acquainted with various stocks and funds. Now it's time to start doing research on what to invest in. There are different ways to invest in the stock market, and there's a lot to know, so doing your research is well worth your time. Stocks are a good option to consider if you want to invest in specific companies. Just keep in mind that you should look into the company itself and how it's performing over time. Step 4. Define your investing strategy. The main things to consider when defining your investment strategy are your time horizon, your financial goals, risk tolerance, tax bracket, and your time constraints. Based on this information, there are two main approaches to investing. Passive investing and investing strategy that takes a buy and hold approach. Passive investing is a way to do your investments for maximum efficiency over time. In other words, you can do it yourself instead of working with a professional. A buy and hold strategy focuses on buying investments and holding onto them as long as possible. Instead of trying to time the market, you focus on time in the market. Active investing, an active approach to investing that requires buying and selling based on market conditions. You can do this yourself or have a professional manager manage your investments. Step 5. Choose your investing account. After choosing your investment strategy, you want to choose an investment account that can help you get started. Decide if you want to do it yourself or get a professional to help out. Step 6. Manage your portfolio. Now it's time to start managing your portfolio. So that means buying stocks, ETFs, or index funds with their appropriate codes from your account. That is when your money is actually invested. But it doesn't stop there. You also want to continue to add to your portfolio, so consider setting up auto deposits each month. You can also reinvest any earnings or dividends to help build growth over time. Diversify your portfolio by investing in different types of investment vehicles and industries. A buy and hold approach is typically better for beginner investors. It can be tempting to try out day trading, but that can be very risky. focus on investing for the long-term. Stock market investments have proven to be one of the best ways to grow long-term wealth. Is stock investing safely for beginners? Yes, if you approach it responsibly. As it turns out, investing isn't as hard or complex as it might seem. That's because there are plenty of tools available to help you. One of the best is stock mutual funds, which are an easy and low-cost way for beginners to invest in the stock market. These funds are available within your 401(k) IRA or any taxable brokerage account. An S&P 500 fund, which effectively buys you small pieces of ownership in about 500 of the largest US companies, is a good place to start. The other option, as referenced above, is a robo-advisor, which will build and manage a portfolio for you for a small fee. Are stock investing apps safe? Generally, yes, investing apps are safe to use. Some newer apps have had reliability issues in recent years, in which the app goes down and users are left without access to their funds, or the app's functionality is restricted for a limited period. Even in these instances, your funds are typically still safe, but losing temporary access to your money is still a legitimate concern. So, if you're hoping to avoid these issues, you can choose an investing app from a large and established brokerage. Fidelity, TD Ameritrade, and Charles Schwab all receive top marks on our list of the best stock apps, and they're also among the largest brokerages in the country. Can I invest small amounts of money in stocks? Yes. Most brokerages these days have $0 account minimums, meaning you can open an account without funding it first, and some even have fractional trading, meaning you can invest low dollar amounts, think $5 or $10, rather than pay for the price of an entire share. However, investing small amounts comes with a challenge: diversifying your portfolio. Diversification, by nature, involves spreading your money around. The less money you have, the harder it is to spread. One solution is to invest in stock index funds and ETFs. These often have low investment minimums, and ETFs are purchased for a share price that could be lower still, and some brokers, like Fidelity and Charles Schwab, offer index funds with no minimum at all. And index funds and ETFs cure the diversification issue because they hold many different stocks within a single fund. The last thing we'll say on this: investing is a long-term game, so you shouldn't invest money you might need in the short term. That includes a cash cushion for emergencies. Is it really worth it to invest small amounts? Regular investments over time, even small ones, can really add up. If you invested $100 per month for 30 years and it grew conservatively at 6% annually, you could have over $100,000 after 30 years. Use our investment calculator to see how compounding returns work in investing. The key to this strategy is making a long-term investment plan and sticking to it, rather than trying to buy and sell for short-term profit. What are the best stock market investments? In our view, the best stock market investments are often low-cost mutual funds, like index funds and ETFs. By purchasing these instead of individual stocks, you can buy a big chunk of the stock market in one transaction. Index funds and ETFs track a benchmark, for example, the S&P 500 or the Dow Jones Industrial Average, which means your fund's performance will mirror that benchmark's performance. If you're invested in an S&P 500 index fund and the S&P 500 is up, your investment will be too. That means you won't beat the market, but it also means the market won't beat you. Investors who trade individual stocks instead of funds often underperform the market over the long term. How do I choose my stock investments? The answer to what you choose to invest in really comes down to two things: the time horizon for your goals and how much risk you're willing to take. Let's tackle time horizon first. If you're investing for a far-off goal, like retirement, you should be invested primarily in stocks. Again, we recommend you do that through mutual funds. Investing in stocks will allow your money to grow and outpace inflation over time. As your goal gets closer, you can slowly start to dial back your stock allocation and add in more bonds, which are generally safer investments. On the other hand, if you're